We don't have a moderator, so I'm going to volunteer. My name's Tim Enneking. I'm the founder and managing partner of Psalion, which is way in the bottom row and all the way over on the left on all of these charts here, silent P. And we want to run one of the largest non-retail Bitcoin yield farming, ETH yield farming, Solana yield farming, and USDC yield farming operations in the world. We're getting encroaching on $500 million right now in terms of AUM.
I'm happy to do an intro on myself too. I'm Boris Alergant. I'm at Babylon, and we build trustless use cases for Bitcoin to make it a more productive asset. Our first use case was Bitcoin staking, with about $6.5 billion locked in the protocol. We're also announcing a new use case of Bitcoin lending that's made available through trustless vaults. This is built all on Bitcoin, locked with Bitcoin technology, using UTXO transactions, scripting, and Schnorr signatures.
That's quite a place to start for some very technologically sophisticated innovators like these two. I'm Gordon Grant. I'm here with Bitwise. What I do for yield on Bitcoin is a lot simpler. I take vanilla options and generate what we think of as static return or incremental alpha through a series of proprietary trading strategies. And hopefully we'll have a chance to talk on this panel about risk and variance and yield and how we see that each through our own different lens and how those may be related. So,
actually, I want to ask you a question, because what we do with allocating to liquidity pools, we actually don't sell the underlying, and we allocate liquidity pools with the same asset on each side. So we've done 500,000 allocations, more than 500,000 allocations, and never had a loss. So the returns, for Bitcoin, it's like 5%. It's not through the roof. For USDT, it's like 12. But you're actually, if I understood correctly, doing a trading strategy. So our risk, we've got a Sharpe ratio of like 6 for this entire year. How do you mitigate the risk? Because you're sitting on your Bitcoin, you've got thousands, hundreds, nowadays people have hundreds of thousands, but you've got 100 Bitcoin, you got 1,000 Bitcoin, serious money. You're going to give it to somebody to manage for. That's already a big psychological step. How do you address the risk concerns from someone that gives you assets?
Yeah, that's a great way to frame the infrastructure of what goes into what I think of as the simple, honest promise of yield or return on Bitcoin. Boris has talked about vaults. We use something that is a prototype of a vault, which is a tri-party agreement with a custodian. So the asset manager, in my case, doesn't touch the Bitcoin. Bitcoin sits in a custodial wallet and a tri-party wallet administered by a custodian to allow it to serve as a collateral for the derivative transactions that we undertake. So that's the first level, which is security. As far as the strategy, it depends on what you could think of as a Bayesian framework, a conditional probabilistic framework for looking at what Bitcoin's expected return distribution could be, depending on its levels of implied volatility, and how good we are in interpreting where there may be discrepancies between how that materializes and how it's priced today.
Well, that's just a fancy way of saying how good your derivative trading strategy is. So how good is it?
Well, historically, for representative accounts that I've managed going back to 2021, it's not quite as good a Sharpe as yours, but it's about a 2.5 Sharpe.
That's an awesome Sharpe.
Yeah, thank you. Appreciate the kind words. The strategy is presupposed to target what we think of as a maximum monthly drawdown of about 1%. Now, how do you do that? Of course, you use options and other financial math to make a prognostication about loss tolerance thresholds for options that you're short. Now, if you hold Bitcoin and you've held it for a long time, especially if you're a US taxpayer, losing your Bitcoin in a principal erosion event is a terrible thing. And so we have to think very carefully, not just about how we set the portfolio up, but how we both buy and sell call options that we trade to ensure that, to the greatest extent possible, we don't have an in-the-money condition for options that we sell.
So what's your average yield?
Well, another good conditional probabilistic question. So today, right, where's Bitcoin vol? Anybody know? Anybody have any ideas? Is it a 5 handle, 4 handle, 3 handle? 3, that's right. So Bitcoin volatility today is measured by the options market at the 1-month point. Going into the FOMC, it was a bit higher on the front end, is only about 35%. This is historically in the bottom quintile of all observations of implied volatility, even with Bitcoin sitting north of the 95th percentile of all-time prices. That makes my job very hard. Because with vol at this level, it is unlikely that you are going to be able to achieve the types of double-digit returns that my strategy would have had in the past. You have to fight very hard to find alpha that will even get you.
But you're not answering the question. Over the last 6 months, what's your APY?
So year to date for, again, representative accounts, and I say representative because I manage SMAs, not a fund. Every account may have slight variations, but it's about 5% year to date. Now, this time last year, it would have been at least 250 basis points higher because vol was twice where it is today.
Right. Okay. Well, how about you, man? What sort of yields are you churning out?
Yeah, for Bitcoin staking, our first product with the 6.5 billion TVL, we're at the lower end. We're at about 50 bips. And we believe that the risk and reward are reflective of each other. Staking, in our mind, is the least or the most risk-averse thing you can do right now in the crypto ecosystem. And therefore, the payout for that should be measurable and reflective of that.
And what's your Sharpe ratio?
We don't have a Sharpe ratio.
Should calculate one. It's easy to calculate.
There's no variance.
There's no variance.
The Sharpe is undefined. That's how good it is.
It depends if you lock it up for long term because you can also get changing yields. We shouldn't apply a Sharpe ratio because our yields are so steady. Our Sharpe ratio for 2023 for our three main assets is between 9.6 and 10.3, which is insane because, like you don't apply it. But because you're in crypto, people want you to apply a Sharpe ratio, whether it makes sense or not. Anyway, to summarize, this is interesting because you have a really good spectrum here. You have 0.5% with something that is so stable, a Sharpe ratio in general terms doesn't even apply. You have what we're doing, which is like 4.5 annualized at the moment with a Sharpe ratio of 6. And then in the third corner, you've got a higher rate of return between 5 and 7.5% with a lower but still excellent Sharpe ratio of 2.5. So it's a really interesting spectrum. You can pick your poison in terms of what sort of yield you want. So now the $64 question really in this context is capacity. You don't have a lot of capacity constraints if you've got 6.5 TVL. Because that's really good.
Yeah,
I mean, it's huge. We don't have that. Do you have a capacity constraints?
Depends on the growing Bitcoin derivatives market liquidity, and that is a surprisingly salubrious picture. I think if you follow Bitcoin,
I like salubrious. That's a good
word. I had to get that in there. Somehow.
Yeah, I know you're doing 5-syllable words. I know.
Says the man in the paisley jacket. But in any case, yeah, I mean,
not exactly paisley.
Yeah, something like it. Bitcoin options market volumes per year have increased materially, both in dollar and Bitcoin terms, more or less as a secular trend. And this year, we are probably going to be at a multi-trillion-dollar annual volume across IBIT, the newer entrant, which is more or less, been a twofold increase to what Deribit was producing.
But that's the whole market. How about your strategy?
Yeah, well, that contributes to it, though. So I say that
of course, there's a context.
Way of meaning. I think that given where volumes traded are today, this type of strategy can accommodate in the single-digit billions of dollars equivalent, right? So tens of thousands of Bitcoin can be absorbed at current degrees of spreads and liquidity. And in fact, there are some large players out there that are running strategies like this on north of 10,000 Bitcoin.
Sure. Yeah, and for us, we have a capacity constraint. It's probably around $500 million before you start driving the return of the liquidity pools we allocate to. And as I said, same asset on either side, so we've never had an impermanent loss. But we don't have nearly the capacity that these gentlemen have. So what other good questions have investors asked you guys that we haven't discussed yet here? Liquidity, I can think of one. We have 6-hour liquidity. What's your guys' liquidity?
Again, depends by the managed account, but that's part of the beauty of the flexible arrangement. Liquidity could be as good as hours, right? If not minutes, within liquid, transparent, tradable.
Does liquidity affect the rate of return?
Not really. I would say in some sense, better liquidity is consistent with decreasing volatility, which acts as a ceiling on returns. The achievable returns today are probably half of what they were a year ago based on levels of vol. But liquidity continues to improve. Vol seems to be finding a baseline. If you listen to Mr. Michael Saylor, which I think we should all do, his expectation is that Bitcoin volatility will be somewhere around 25 to 30% as a long-term horizon. Bitwise's long-term capital markets report on Bitcoin has foreseen similar things. I think that as long as there are large amounts of capital washing in and out of the market, it will keep it liquid, but it will probably also keep it sufficiently volatile to leave something for us poor portfolio
managers. So you're still looking at perhaps up to into billions, single-digit billions for your specific strategy for the foreseeable future.
Yeah, and again, depending on what Bitcoin does, I like to think in Bitcoin terms. So let's say tens of thousands of units of Bitcoin. If Bitcoin is at $500,000, it's a lot more, obviously.
Yeah, got it. How about you, Boris?
Yeah, look, liquidity constraints are our end. I mean, well, when it's a little bit different with the staking protocol. I think the way you think about it is how quickly can you get your Bitcoin back once it's locked up? And the protocol is designed for T+2. It's actually 300 Bitcoin blocks. And that's a lot different than Ethereum because there's actually no entry or exit queues. This is a parameter that's set, T+2, 300 Bitcoin blocks. You click unstake, you will get your Bitcoin back. And that really works for a lot of ETF issuers and a lot of financial firms that need to have that T+2 settlement.
So you're really talking 48 hours.
48 hours.
Or 40-hour business hours, I suppose.
Exactly.
Interesting. Are you constrained over the weekend? Not a big deal. I'm just curious.
No constraints. This is all running on the Bitcoin network.
Yeah, okay.
So Bitcoin's 24/7 and so are we.
Right. Interesting. Well, guys, we have to keep this short because somebody rudely intruded on our time before we got started. Any other last thoughts?
No, I think it's great that Boris brought up the withdrawal times on the Ethereum network, though, because the one thing that I would leave everyone with, especially coming on the heels of Michael Saylor's excellent pitch about infinite duration capital, duration is a measure of time. Time is proportional to variance. When you think about the type of yield that is achievable on your asset, especially if it's Bitcoin, you also have to think about how long it's committed for, what duration risks you are taking, and finding what we think of collectively here amongst us three as the maximum amount of return with, I would say, a reasonable bite size on duration. It can be both a friend and a foe.
Yep. I would say, look, Bitcoin is a $2 trillion asset class, and a lot of it's just sitting idle. It needs to be made more productive, right? Like any financial asset, efficiencies need to improve. And I think you have folks on this panel here today that are figuring out ways to make your Bitcoin more productive in order to generate some kind of income, some kind of returns. And that trend's only going to continue. Right now, Bitcoin is definitely in a bull market. And that, appreciation is 50% per year, roughly, is what Mr. Saylor was saying. But at some point, like any economic cycle, there will be a flatline period or perhaps a down period where income generation and making those assets productive becomes very important to a lot of treasury companies as well. So it's something to keep in mind.
We've sort of made an assumption here that I'm not sure is worth a separate discussion or not, but that is someone's willing to surrender their Bitcoin, right? The three of us are really advocating something that's antithetical to my keys, my coins, because you may have multi-sig arrangements. You can do various arrangements depending on what the details of all three of our strategies are. But you have to cross the Rubicon, which has come up twice now today, to decide to not have physical, to the extent that applies, custody of your Bitcoin. And there are some people that are just not comfortable with that. I respect that. I know that. My response to most people is simply diversify. In fact, if you want to, don't use all three of these strategies and hold on to a good chunk of your BTC as well. Diversification is a key to almost any investment. But I agree with Boris. The idea of just sitting on Bitcoin, it's lovely during a bull market, which you really experienced since November 15th, 2022, when FTX went down. We've been on an upward trajectory since then. But that's going to change. It's not always going to go up. And there are different assets as well besides Bitcoin that you can hold. It starts to make more and more sense to look for yield of some flavor. And you've got three really good examples, very different examples: derivative staking and yield farming or allocation to liquidity pools right here on the stage. It's worth thinking about. And if you want any more information, you guys can look on the agenda and get a hold of any of us.
I'll start with the first question. We've got about 10 minutes left here. One of the points I made to all three of you when we were briefing for this was, having worked at Mara with our sats per vbyte at 1, sometimes 2, the miners will say, well, taking all this Bitcoin off chain to go stake it somewhere or put it into some DeFi protocol is hurting the mining model. Now, since there's no way to get yield out of Bitcoin because Bitcoin doesn't have yield, having to take it off chain and park it doesn't that hurt Bitcoin and help whatever protocol or Rubicon that you guys are working with?
I would say the exact opposite. I mean, we have clients who are Bitcoin miners, and they don't want to sell their BTC, and they'd rather earn yield on it, because that means ultimately when they do have to sell to fund operations, et cetera, they sell less. I don't know. What do you gentlemen think?
Yeah, look, we have a thesis that Bitcoin is the best asset class in the world, right? And people don't want to sell their Bitcoin. They want to accumulate more. And we also have a thesis that other crypto ecosystems might be around for the foreseeable future. So with Bitcoin staking, the Bitcoin's never leaving your wallet. It's never leaving the Bitcoin network. And you are earning yield in other assets, or earning rewards in those other assets that you can then sell for more Bitcoin. So it's an accumulation strategy. So if anything, this increases the use of Bitcoin and the native use case of it, and gives it more purchasing power.
Yeah, my comment there would be simply to say that when you do a derivatives trade and you take your Bitcoin and you move it from your own personal wallet, cold storage, custodial segregated wallet, to what we think of as a tri-party wallet, a collateral vehicle, you're actually helping fulfill Bitcoin's promises, what Michael Saylor calls global digital capital. There are very few assets that you can very easily take and post as collateral in kind for a derivative transaction. Bitcoin is one of them. Even today, for large liquid precious metals, unless you are an extremely institutional actor, you can't take your bars of gold out of your safe and go hand them over to your bank with whom you trade an OTC gold options contract. Bitcoin is actually an exception to that rule, and allowing it to fulfill that purpose is a powerful component of its mission.
I'd also add something else in answer to it, which is, it's peripheral, but I think it's a very important point, and that is particularly in the US, taxation. None of these strategies, notice this is staked, Bitcoin's not sold. You're using it as collateral, the Bitcoin's not sold. We're doing allocations of liquidity pools, the Bitcoin's not sold. One of the critical things is a lot of people, I'm sure sitting in this audience, have really low basis Bitcoin. Not only do you not want to sell it because you think it's going to appreciate, you don't want to sell it because you don't want to end up paying capital gains on all of that difference between the basis and the market price. None of these strategies, and yours in particular, is designed so you don't have to sell, because you could do your strategy a very different way, but it's far more tax efficient the way you're doing it. So just as an aside, that's an important consideration. And all three of the strategies, I can tell, very much take that into consideration.
Question for Tim and Boris, maybe a little bit more. What's the biggest barrier you're seeing to companies in the Bitcoin Treasury space that may be hesitant about going on chain or putting capital in sort of a more blockchain-based setting than a traditional financial alternative?
Yeah, I think a lot of the companies we talk to that are more on the traditional side, right? They have they have a lot of hesitation in terms of deploying on chain. Part of it is regulatory, part of it is AML, KYC. Although lots of funds do get comfortable with us, and that's kind of how we did get to that $6.5 billion in TVL. But I would say it's mostly just understanding the technology, understanding where the risks may lie with it, especially if you're a traditional investor on the AML KYC side, and ultimately they all do get comfortable after conversation with us.
It's a really good question. If I were to put the statistics out about the investment, okay, 6-hour liquidity, no lockup, no fees going in, right? In Bitcoin, 4.5% a year, and no realized taxes with this Sharpe ratio. People would fall all over themselves giving us the Bitcoin. But then we had this, even the crypto native people, we had this one little 2-syllable word, and people start having second thoughts, and that is DeFi. And DeFi is interesting because the field of DeFi has become so incredibly broad. To me, it's not much of a limitation. It's almost a word without significant meaning because it is so broad. But there are a lot of people that are still concerned, and it's more of an abstract concern or an abstract fear about DeFi. Because if they get over that and look how we've structured everything, zero and permanent loss, and hundreds of thousands of transactions without a non-positive, or where every result was positive, some get comfortable with it, but some never get over the hump. Oh, it's DeFi. I hope that answers the question.
Anybody else? Shout out to one of our sponsors, BitcoinYield.com, who just launched their website about a week ago. Jesus, are you in the room? Nope. Probably out in the lobby, BitcoinYield.com. Boris, I can't wait until you and I can finally say to some of these kids, it's like, we've been in Bitcoin longer than you've been alive, right? It's coming. It's coming soon. Well, I think we can wrap this one up and get some time back here. Thank you three very much.
Thank you all very much.
Bitcoin custody is evolving, and OnRamp leads this change with multi-institution custody, eliminating single points of failure. Instead of one institution or complex private keys, OnRamp secures your Bitcoin in a segregated, cold storage, multi-sig vault backed by 3 independent, institutional-grade custodians. No single custodian can move funds by themselves, providing an unprecedented level of security that traditional custody solutions simply can't match. Protected by a $100 million Lloyd's of London insurance policy, all transactions are fully auditable on-chain, never rehypothecated, and executed only at your explicit direction. This means complete transparency and control over your assets at all times. Beyond custody, OnRamp delivers comprehensive Bitcoin financial services, including lending, trading, inheritance planning, IRAs, and more. OnRamp functions as your private banking partner, coordinating key holder activity, removing technical burdens, and providing a personalized, trust-minimized experience tailored to your specific wealth preservation goals. Whether you're new to Bitcoin or an experienced holder, OnRamp's approach helps secure generational wealth with unmatched security and peace of mind. Visit onrampbitcoin.com today to learn more, sign up, or book a free consultation with their team of Bitcoin custody experts. Hey guys, today's episode is brought to you by StampSeed. If you're in cold storage, you know how important it is to protect your seed phrase. That's why I recommend you head over to stampseed.com and check it out for yourself. This seed phrase storage device is one solid piece of titanium. There are no loose pieces, and you can hammer your seed phrase in letter by letter. When you go to stampseed.com, use promo code TIM15 for a 15% discount across the website. That's TIM15. Join us at the Win in Las Vegas, February 23rd through the 26th, 2026 for Bitcoin for Corporations. Use code KOTZ when you grab your tickets at strategy.com, and we'll see you there. This episode is brought to you by Arch Lending, the premier provider of crypto-backed loans designed for both individual and institutional investors. At Arch, your digital assets work for you without selling them. Arch offers flexible loan options tailored to your needs. Backed by industry leaders like Morgan Creek Digital, Castle Island Ventures, and Galaxy Ventures, Arch Lending is setting a new standard in crypto-backed lending. Are you ready to unlock the potential of your crypto assets? Visit archlending.com to learn more and configure your loan today. Are you looking for comprehensive analytics on corporate Bitcoin adoption? Strategy Tracker delivers real-time insights into how companies are executing their Bitcoin strategies completely free. Monitor NAV premiums, cost basis performance, and track how corporate Bitcoin treasuries perform against the market. Upgrade to Premium for just $3.99 a month and unlock exclusive benefits like detailed market rankings, real-time trading volume analysis, and advanced performance metrics for corporations embracing Bitcoin. Apply code KOTZ at checkout for 100% off your first month of Premium. Strategy Tracker is your essential tool for measuring the effectiveness of corporate Bitcoin strategies. Visit strategytracker.com and gain the analytical edge in understanding the Bitcoin Treasury phenomenon.